Okay, traders, welcome back to the Price Action Labs Order Flow Series Part 9, right? So I've got to make this video in light of the January price action that's been pretty rough for me and a lot of other people in the community, and of course on Twitter and Instagram, people are really complaining about the rangy price action. But nevertheless, we're going to be going over order flow. We're going to be going over 2 trades you could have taken from January. Just a quick FYI, for your information, I didn't quite catch these trades because of my psychology. We're going to be breaking down how you can identify your psychological problem, identify the roadblock that's giving you the psychological problem, and how you can fix that using this unique and interesting order flow series video. So order flow, let's quickly go over a quick brief down of order flow. So I've made previous videos on this. I highly recommend checking them out. So ICT and order flow, what we're going to cover in this video, right? So we're going to be understanding how to read a basic footprint chart, how to manage your emotions in the market, and my unique mechanism which combines ICT concepts with order flow. So when I say ICT concepts, I'm really referring to fair value gaps, because fair value gaps are the most important thing. Later on in this video, I'm going to show you exactly why they are the only thing you need to become profitable. Things like liquidity, power of 3, all those things are kind of secondary, but if you can understand ICT and order flow, you can become the greatest trader you can possibly become, right? So what is the market? It's important to understand this. I'm going to quickly go over this. So the market is only an auction. It is not an algorithm. It is not a bot. It is not run by AI, right? Yes, we have big players in the big financial corporations and institutions, i.e. banks. But from our perspective, sitting at home on our laptops with our internet connection, we need to understand the market in terms of 2 participants, right? So the banks, the institutions, the algorithms, whatever you want to call them, they all come down to 2 fundamental principles, right? Buyers and sellers, right? So we have the ask and the bid. I've been over this in previous videos. I recommend checking it out. We're going to get really much into this in this video. We're going to be understanding the buyers hit the ask and the sellers hit the bid. The only thing you need to become profitable, and I'm going to break this down later on in the video, is fair value gaps with market auction theory, right? So what are footprint charts? So footprint charts essentially give you 2 numbers, the bid and the ask. The bid represents aggressive selling or aggressive sellers, and the ask represents aggressive buyers, right? So you can see over here on the right-hand side of the screen, you can see some numbers. Any number on the left represents the bid, any number on the right represents the ask. Now, the numbers you see on the far right of the footprint chart, this refers to the volume, right? So the volume is just the bid and the ask. So think of the volume as the total number of transactions in that candle for that price. So market auction theory is very important because we discussed in the previous slide that there's buyers and sellers, but there's 2 types of buyers and there's 2 types of sellers. We have aggressive participants, aggressive buyers, and aggressive sellers, and we have passive participants, i.e. passive buyers and passive sellers. So we're going to be going over how you can use both aggressive and passive participants to catch great trades. And just a quick tip, you only need fair value gaps from the entire ICT arsenal to trade this properly. Fair value gaps aren't needed. So to give you some context, the numbers you see here, the bid and the ask, those are aggressive participants. So those correspond to number 1, right? Those are aggressive participants. What we're going to be focusing on is passive participants, right? So we're going to be understanding what passive participants actually mean, right? So my unique mechanism is very simple, and this is how I trade. I look for a 15-minute fair value gap. I wait for the 1 minute to come into that fair value gap, and then I use order flow to trade properly, right? So let's break this down. So here we have the 15-minute time frame of ES, and we're going to be going over my chart settings, right? So on the regular candlestick chart, which by the way, cannot give you the full story. So we're going to be breaking down a trade you could have taken here and a trade you could have taken here. So this is now Thursday and Wednesday so that's the 22nd and 23rd. But it's important to understand you will never get the full complete picture from using this chart. Later on, I'm going to show you how you can combine candlesticks with order flow to correctly trade and therefore reduce your emotions. But one question I often get with my strategy or just my chart settings is how do I, set my charts, right? So I only use 2 indicators, and I call them indicators because technically they come under indicators, but they're not really indicators. The first thing I look at is the power of 3, right? So if we just take a look at this and rewind price, I look at the power of 3. Now, in particular, I use the daily power of 3 and the 4-hour power of 3, right? So my settings on the power of 3 are very simple. I will use the daily power of 3, and I'll always select this New York midnight opening price. By doing that, it basically sets the New York midnight opening price to be at 5 a.m. UK time or midnight New York time, Eastern time. So the reason I have this indicator is very, very simple. Let's say if the opening is around this region, I want to be looking for buys that are below this area. So I'm looking to trade this wick, right? So if I can catch this wick successfully, what that then means is that I can then obviously catch the expansion, right? So the expansion is, of course, this large move over here. So I'm positioning myself correctly as a trader. That's the most important thing you need to understand, right? The second indicator I use is, of course, the Asian range. Now, so the Asian range is from 19 o'clock to midnight New York time. So just pause this video, take a screenshot of this, and apply this to your charts, right? So the Asian range indicator I use is by, I believe it's Rob Minty. That's the name of the indicator. So go to the Asian range, or you can use any indicator of the Asian range, right? So what does the Asian range do? So the Asian range, we're just going to be going over this very quickly. The Asian range builds liquidity. This is the ICT accumulation. So the ICT accumulation, very, very simply, its main job is to build liquidity. So we want to be focusing on the Asian range high and the Asian range low. So when we use this in conjunction with the power of three, what we're understanding, right? What we need to understand as traders is that the market will move down before it goes up. And we use this in line with the Asian range. So what that means is when you have an Asian range, the market will very, 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 very often sweep the Asian range low before it heads higher. This here takes out the Asian low. So the Asian low is what's taken out over here. And we look for the low of the day below this Asian range. So this low of the day will correspond to this daily wick. In order to understand the daily wick, you just want to understand that price action will often sweep the Asian low before ultimately heading higher. That is the main thing I want traders to understand. So these aren't really fancy indicators that are going to tell you what to do. They're simply tools that you can use to your advantage. That's all it is. So the Asian range will typically tell you where you want to be buying and selling and when you want to be buying and selling. And the main trick to understand with the Asian range is you want to be selling after price has taken out the Asian range low. Now, with this being said, let's just dive into the strategy and see what we get. So if I just get rid of the power of three indicator, I, in this particular session, was looking for an inefficiency or an imbalance, right? So I'm looking for some kind of fair value gap over here, right? So if we continue, if we just kind of draw price back, I'm looking for some kind of a level on the 15-minute chart, right? The 15-minute chart is the golden time frame I use. It is the most important time frame. So if I continue to play price on and see what we had in New York session, right? New York session gave us this level, right? So this is my key level. Market open 9:30 Eastern or 2:30 p.m. UK time. This was essentially my level, right? So we had a level over here. So this is basically the entire strategy. So you're looking for if I were to write this down, you're looking for a 15-minute fair value gap. You're then waiting for price on the 1 minute to come into that fair value gap. And then you are using order flow to validate your entry. These are the only three things I use to trade. And these are the only things you need as a trader, right? So if we just go down now to the 1 minute time frame. Now on the 1 minute time frame, we are looking for price to do something like this. So as you can see, we're going to now change our indicator. So when I'm in the AM session, I want to be using the 4-hour power of three, right? So the 4-hour power of three will give me an indication as to what's going on. So now let's break this down even further. So again, the strategy we understand, right? We have an opening over here. So we have the 10 a.m. opening in this region. Now prices come inside of this level, and what we're simply waiting for is some kind of an entry model to then take price higher. It's really that simple, right? But what a lot of traders mess up, right? And the reason why they go through all kinds of psychological problems is because they don't even understand what they're looking for. So I'm going to ask you right now, how do you really know what's going on between buyers and sellers, right? You may have an indication, you may know roughly, but I'm going to tell you now, the power of three indicator or any fair value gap alone is simply not enough. Right, so here I want to draw your attention to the footprint chart and the order flow chart, right? So what you need to understand as traders is that we've come into the exact same level. You're looking at the exact same candles, the exact same data on ES, but the only difference now is you're able to understand what's going on between the buyers and sellers, right? So just take a look at this price action over here. 5 minute time frame, of course, we've come into the exact same level, and now we're understanding the interaction between buyers and sellers. So the first thing to understand is we have an entire fair value gap here, and the market failed to break below this fair value gap. This is very, very important to understand. Now that we've not broken the fair value gap, you need to understand what's going on inside of every candle, right? So let's just read the order flow kind of line by line. Let's read the most bottom candle. We have 257 for 23. We have 706 for 360, right? 706 for 360. 467 for 92, and all the way at the bottom we have 108 for 0. So just by reading these two candles over here, in fact we can do this for a third candle, we have 322 for 98, 159 for 0, and 11 for 0. So we see a ton of negative delta, right? What does negative delta mean? Well, if you flick back to the start of the video, negative delta simply means there's more aggressive sellers than there are aggressive buyers. Now, if you were paying attention to earlier on in the video, I was going to discuss to you that anything on the footprint chart is aggressive participants. These are aggressive sellers in this case, right? We have aggressive sellers, and then we have aggressive sellers. Now, we can see the blue delta coming in over here. We can see some blue delta coming in over here. So what the blue delta represents is that we're seeing a shift from aggressive sellers to aggressive buyers. Now, put this into context. When we have lots of aggressive sellers inside of a bullish fair value gap, because remember this is a bullish fair value gap over here, right? You can even see from the footprint chart, we have so many aggressive sellers here and we have so many aggressive sellers here. So if we have a lot of aggressive sellers, right? If the volume is telling us that sellers are aggressive, well, what does that mean, right? The volume is corresponding to aggressive sellers. So if aggressive sellers are trying to drive prices down, what that means is that there's passive buyers that are popping up in this region, right? So I want traders to understand this in terms of how a level works, how a key level actually works, right? So there's so many aggressive sellers in this region. So now if we give this some context back to the regular footprint chart, what I want traders to understand is that we had so many aggressive sellers inside of this region, right? Where I've circled corresponds to what you're about to see now. Where I've circled corresponds to aggressive sellers, right? So we had so many aggressive sellers inside of this zone, but none of them were rewarded, right? None of them were rewarded. So these sellers essentially failed, right? That's a sad face, mind my drawing. A lot of these sellers were failing, right? So when we see a lot of sellers failing, what that means is that there's passive buyers that are stepping in and they're willing to push price higher. So this gives us the only indication that the market is willing to reverse in this area. There's nothing else that will give you the indication. It's important to understand that. Now that we've understood this, right, what we've also understood is that we're below the 10 a.m. open, right? So the 10 a.m. open is this red line over here. This also gives us massive confluence. So if we continue to play price on the 5-minute time frame, let's hop up to the 5-minute time frame. We're below the 10 a.m. Eastern, and what we understood here as traders is that we had a ton of aggressive sellers in this region, right? So I keep banging this on because this is so important. We had aggressive sellers. This is an A, again, my drawing. These aggressive sellers failed, right? They did not drive price down. They are sad sellers. What's actually happened is that we have passive buyers that have popped up in this region. So we can now take a confirmed buy. And the reason this is a confirmed buy is because of the 3 steps I discussed earlier on in the video. So the 3 steps are, we have a 15-minute fair value, right? We have a 1-minute entry or a 5-minute entry, and we're using this with the order flow. So what does the order flow tell us, right? So take notes on this, screenshot this and write this down. We are seeing, this is important to understand, we are seeing aggressive sellers with no reward, right? So we're seeing aggressive sellers with no reward, right? This is important to understand. We're seeing aggressive sellers with no reward. And when you see aggressive sellers with no reward, the extra confluence you can use, again, we notice how we're below the 10 a.m. open. And on top of that, you need to understand that we've taken out the Asian range. We've taken out the Asian range low. So we have a confluence over here. And on top of that, we have a confluence because we're below the 10 a.m. Eastern. Now that we're below the 10 a.m. Eastern, all of our trades now become valid, right? So if you're looking for a buy in this region, the trade now becomes valid because we've seen aggressive sellers fail. This is the most important thing. So you can take a trade in this region and you can comfortably have your stop loss just below these wicks. This is important to understand. We can comfortably place our stop loss in this region because the market has failed to break this area. Now from here, the next question becomes, well, where do we target as traders, right? Let's really zoom out and understand. So your first target is going to be really the high from the previous day, right? We want to simply target previous day highs. If you've not watched some of my previous videos and some of my shorts, I highly recommend checking them out, right? So a previous day high is the next place you want to be targeting, right? PDH, previous day high. The market will spool towards previous day highs and previous day lows. So let's quickly go over this one more time, right? So again, the power of 3 indicator, the power of 3, let's use the daily power of 3, right? So the daily power of 3, what's happening is we're looking to buy slightly below the daily opening Notice how we're kind of making the majority of this wick, and we've caught the low of the day, or we've assumed the low of the day has been put because we're below this Asian range. So we're using the Asian range as a confluence. We're using the power of 3 as a confluence. And now we're targeting the previous day high. Trading doesn't have to be complicated, but I'm using confirmation, which is the order flow, right? Order flow is the greatest confirmation you can use as a trader. Now, of course, the market does eventually rally up in this overall direction with a nice spool to the upside targeting the previous day high. So the main thing you want to understand is order flow. This chart over here is what's going to allow you to catch these large rallies, right? So you see a very, very large rally to the upside, nice 2, 3, 4 hour trade. But again, I'm going to end the video just by making you understand how powerful this chart actually is. So if you're suffering from any kind of psychology, any kind of emotion, it's because you're relying on candlesticks instead of numbers, right? So numbers will give you the true story, because the truth is, you have lots of green candles, but inside of these green candles, you have lots of red. You have lots of red delta. You have a lot of aggressive selling, Now, when you understand where to look for trades, when to look for trades, and why you want to be buying and selling, right? The why will always come from the footprint charts. The why will always come from aggressive sellers and passive sellers, aggressive buyers and passive buyers, right? That's the bread and butter of the markets. That's the backbone of the market. So if you can understand how many aggressive buyers and sellers there are at certain key levels, you have a much higher chance of making it as a trader and catching these high risk to reward trades, right? So if you like this video, give it a like, give it a thumbs up. We are offering free one-to-one sessions over at at Price Action Labs. So if you'd like to kind of book a call with myself and see if this strategy works for you, if you just want to take your trading to the next level, free signals and stuff we offer inside of the lab. So if you'd like to check that out, just comment below and I'll send you the link for that free one-on-one session. But until then, take care, and I look forward to seeing all of you in the next one.